Now, if we turn to Project Blue's copper industry margin curve, what we see is that large-scale concentrate producers continue to dominate the higher quartiles of the margin curve, while it's mainly smaller-scale operations that account for the bulk of assets operating at negative margins. The combination of higher copper prices and low treatment and refining charges has further strengthened margins for concentrate producers, as smelters and refiners with excess capacity have driven down processing charges. At the same time, we've seen a shift towards more underground mining as companies pursue higher ore grades and lower strip ratios. This has, in some regions, then pushed costs up and compressed margins slightly, particularly in parts of South America and Africa. And then if we look at SXEW cathode producers in the DRC and Zambia, who historically have led the margin curve, they've seen a profitability decline in recent years or last year. These producers once benefited from high cobalt byproduct credits, with margins peaking at around $2 per pound of copper during the 2021 price rally. However, much of the uplift was tied to strong cobalt prices, and since then, cobalt prices have collapsed, weighed down by an oversupplied market and underwhelming demand from the lithium-ion battery sector. With byproduct revenue falling and production costs rising, margins for SXEW producers have declined sharply. As a result, concentrate producers have now overtaken SXEW producers on a margin basis for the first time in over a decade. This demand has shifted decisively in favor of the concentrate side of the industry. And then there's one important point to highlight here is that while copper prices today are higher than they were in 2021, overall industry margins are lower. This is a reflection of the significant increase in production costs across the board, impacting margins.